The market, obviously, as they gain momentum, they'll be part of the market. And I think institutions own so little of the precious metals, and that group is such a small capitalization that if institutions ever decide they need to have 5% of that in their portfolio, you can run these things up just on a supply-demand basis for the stocks. So, and that's what I think is going to happen. It doesn't take much when you're in such a small, thin group. When nobody wants them, they can kind of wallow around in the bottom. But once they break above some levels and institutions take notice, it's look out. And in terms of everyday bubble, I hear that a lot. I think it's premature. I mean, maybe stepping back and looking at the big picture, it's maybe a bubble. I think there is a bust to follow. But if we're 40 or 50% away from a top in the stock market, it's a little hard to be talking about a bubble here, right? It is. We are moving into what I think will be a parabolic move. So you can gain a lot of ground in a short time. So time-wise, I think we're not that far away from the top. But distance-wise, the returns we could get this year between now and, say, election time, and probably before that, are the kind of returns that you normally have to wait 2 and 3 years to get. You have to work through several years of returns to get this. And we could get it all in 6 months or less. I think the financials are going to gain momentum here. As I said, the broker-dealer group looks good. Banks, I think, will do well, and probably the larger ones better than the regionals, but the regionals will have a catch-up rally here, I think. I think the industrials still look very good and can continue to lead. Semiconductors, which has been my highlighted group all the way through since, I turned bullish or started talking about this move 20 months ago. As far as they've moved, they still look good. I have a target of 300 on the SMH, and I know that's going to have to be raised. Whether it's 350 or 400, I don't know, but I think that's the kind of upside you still have. And the consumer isn't the place I would probably focus, but I think even consumer discretionary is going to have some room to run. I think steels can run. I think copper has a big run ahead of it. There's just so many places. A lot of the commodity area probably will have a run here. So what could surprise, we had everybody early this year assuming the Fed was going to be cutting well before now, or certainly by now. And now we got everybody assuming, maybe we're going to get one cut this year, maybe no cuts this year. I think the surprise could be that things start slowing here in the summer, between June and August, and the Fed comes back, and the expectations come back around to cuts, where the Fed says, we can't just ignore the fact that jobs picture is starting to deteriorate, bank loan picture is starting to deteriorate, et cetera, and inflation looks okay. So I think, the traders move the expectations around, and the Fed kind of goes with the traders oftentimes. But what we forget is what looks like an entrenched viewpoint by the Fed or an entrenched viewpoint by the market can flip on a dime if you get a few numbers going the other way. And so I can't say for sure that that's going to happen, but I think that's a wild card out there for sure, is that we might be right back in cutting mode here soon, or expectations of cuts. My January investment letter, I raised my targets for the equity market. So I am currently at 7,000 as a target for the S&P. I'm up to 23,000 on the NASDAQ, had been 20,000. My Dow target is now 55,000, and my Russell 2000 target is 3,300. That's probably the one that's the hardest for people to swallow. From here, that's like a 65% move. So, or not from here, but if we correct back down to, say, 2,000, which is about where it looks like the Russell's headed here this week. So, 65% move, and I think that move happens this year and probably happens between late summer and the election sometime. That's a obviously very historic move, and even the S&P from might correct back down to 5150, let's say, which isn't very far from here. To my target, it's like a 35% move. So there's a lot of upside still ahead, and yet, as you said, there's I think a lot of nervousness in the market right now. People looking for corrections and thinking this thing is pretty extended and shouldn't go much higher, if at all. I'm not in that camp. Obviously, I think this thing has legs. It surprised people all year, but in May, I think is the strongest May we've had since 2009. So all those people kind of talking like this thing's not done well. It's done well all year and it's done well recently. So I think its perception is not reality. And I continue to say melt up ahead. We're in a melt up, and that melt up is just going to get steeper from here. When I stepped back and looked at the indexes, it looked like there was more room upside from where I had a target 6,000 to 7,000 for the S&P, so it really wasn't a big change. Although then my convictions had grown that we were going to see the upper end of that band. For the Russell, which is the farthest from its target, it just looks to me like it is going to break out once it gets going here. I think you're going to see it really gain some speed and take leadership from some of the bigger cap stocks. So it was more seeing that this thing is reaching its fruition in terms of gaining traction and fought through a lot of the skepticism, and now seems to me clear sailing ahead. You're going to have 2 and 3 and 4% corrections along the way, or pullbacks along the way. They can happen anytime. So I'm not worried about this most recent couple days. Probably has a little more weakness ahead this week, but by Friday or Monday, this thing could be back up and on its way to new highs. So to me, rates are causing a problem very short term. You've had a backup in rates, but this week the Treasury's selling an awful lot of bonds. There's several auctions this week. Today was the 7-year, I think. Tomorrow's the 10-year. So you're seeing supply come in large numbers, and that always causes some congestion. Rates have to go up to allow the dealers to be able to market this stuff and get it out. The 2 auctions so far this week haven't done great. They indicate that there's some reluctance to buy. So you get a backup in rates of 10 or 20 basis points, and then gives you room to go. I continue to say I think the bond market's in good shape. I don't expect, can always happen because we're at 460 on the 10-year, can always see 5%, but I don't expect that. I think we're nearing the end of this backup in rates. If you go back and look, we've really had a counter trend move in rates back up throughout this whole 5-month period this year. Started at the beginning of the year, has been, choppy upward since. We came down from 5 to 380 on the 10-year last year, the fourth quarter. And what we've done here is gone and retraced a good portion of that, but not all of it. We've gone from 380 back to got up to 473, I think, in April, and we're at 462 now. I'm still saying I expect a sub 3% move in rates this summer into the fall. So that'd be a nice move in bonds. And if you get that, and I also expect the weak dollar, you get those things happening, and I think you're going to see the stock market do very well. We had an uptick in rates and inflation in the first quarter. When you look underneath the surface, the PCE deflator is 2.7. We're moving towards that 2% target. We came all the way down from, much higher. It's just not coming down quickly anymore. The easy part of the move has happened. Now it's more grudging, and you get some, it's kind of a sawtooth thing. You get some back up and then it comes down. But the economy is not in great shape. I mean, you still have people believing we're not going to see a recession and that it's stronger than expected, but really underneath the surface, consumers starting to run into resistance here. Their consumer confidence has been off the last couple months, not necessarily the conference board number that came out today, I guess, an uptick. But basically, consumer confidence, Michigan consumer confidence is showing indications of consumer rolling over, being concerned. You see delinquencies in credit that are picking up speed. I just think we're at a kind of a level where you can't expect the consumer to carry this thing for much longer. We're not imminently ready to roll over in the economy, but we're also not super strong and going to be pushing inflation fires. So, you're in that period. I talked about this many months ago, that I thought the last stage of the equity market would be partially driven by a kind of a porridge just right type of a mentality where it's not too hot, not too cold. We're not heading for a recession, but we're not also seeing inflation fires roaring ahead. So I think we're in that kind of sweet spot. It's not a glorious thing, but it keeps the market moving. And I think there's still a lot of skepticism among investors. Retail investors have pulled back. A recent Schwab survey showed that they're concerned, and the institutions continue to kind of fight this thing. As always, the momentum has been pretty good here this year, so in the market. So, they have raised their targets to mid fives, 5,500. You're not far away from that. But I think they all feel like there's a lot of problems that could surface at any time. So the skepticism there, a lot of worry is there, and that's what fuels an upside.